Imagine waking up tomorrow morning and finding out that your father has passed away. The grief is overwhelming. Family members are crying. Phones are ringing. Funeral arrangements need to be made. Then someone says something practical. Don't worry, he left money in the bank. For a moment, everyone feels relieved. At least the bills can be paid. At least the family won't face financial problems. But then something shocking happens. You open the banking app. The balance is still there. $50,000, maybe $100,000, maybe even more. The money hasn't disappeared. Nobody stole it. The bank still has it. Yet when you try to transfer a single dollar, the screen flashes an error message. The debit card stops working. Online banking is blocked. The account is frozen. Suddenly, money that belongs to your family feels impossible to reach. Now imagine this gets even stranger. Two families lose a loved one on the same day. In the first family, the surviving spouse can still access the money almost immediately. In the second family, the money is locked away for months. Same country, same banking system, sometimes even the same bank. So why does one family get access while the other is trapped in a financial nightmare? The answer leads us into one of the least understood systems in modern finance. A hidden world of probate courts, beneficiary forms, bank policies, estate laws, and paperwork that most people never think about. A world where one forgotten signature can determine whether your family receives your savings in days or spends months fighting to get it. And here's the scary part. This isn't a rare problem affecting a handful of wealthy families. Every year, millions of deaths occur around the world, and many families suddenly discover that accessing money after death is far more complicated than they ever imagined. Banks don't simply hand over cash because someone claims to be a son, daughter, or spouse. They need proof. They need authority. They need legal certainty. In fact, many people believe that if they know a parent's password, PIN number, or online banking login, they can simply access the account after death. That sounds logical, but in reality, the moment a bank officially learns that the account owner has died, completely different rules can begin to apply. Rules that can instantly shut down access to money. And if you think a will automatically solves everything, think again. One document can say the money should go to a daughter. Another form hidden deep inside the bank's records can say the money should go to a son. When those documents don't match, families can find themselves in emotional battles that last far longer than anyone expected. But here's the biggest question. If the money already belongs to the family, why would a bank freeze it at all? Why not simply give it to the next of kin? Why create more stress for people who are already dealing with one of the hardest moments of their lives? The answer is surprisingly simple, because banks have seen what happens when they don't. Imagine a man dies unexpectedly. Three relatives arrive claiming they deserve the money. One shows a will. Another claims there is a newer will. A third says the deceased promised the money verbally. Suddenly, the bank is standing in the middle of a legal battlefield. If it releases the money to the wrong person, the consequences can be massive. Lawsuits, fraud claims, financial losses. That is why banks often freeze individually owned accounts once death is confirmed. Not because they want to punish families, not because they want to keep the money, but because they must protect it until the law determines exactly who has the right to receive it. The freeze is designed to stop chaos before chaos begins. But here's where this story becomes fascinating. Not every account gets frozen. In some cases, a surviving spouse can continue using the money with little interruption. In other cases, the exact same amount of money becomes trapped inside a legal process that can take months or even longer. The difference often comes down to paperwork signed years before anyone ever thought about death. And buried inside that paperwork is a financial secret that most people never learn until it is too late. A secret that determines whether your family inherits your money smoothly or inherits a financial nightmare. So how exactly does a simple bank account transform into a locked vault the moment someone dies? To answer that, we need to follow the story of one ordinary family whose savings became trapped behind a wall of legal rules they never knew existed. Robert was a normal man from Ohio, not rich, not poor. He worked for decades, paid his taxes, and slowly built his savings inside one simple bank account. He believed something very common. If something happens to me, my family will automatically get everything. He never thought too much about legal documents or bank rules. For him, saving money was enough. But reality was waiting for him in a very different form. One morning, Robert suffered a sudden heart attack. Within hours, his family was in shock. Doctors tried everything, but he didn't survive. In just one day, day, a normal family became a grieving family. Bills, funeral costs, and emotional pressure all arrived at the same time. His daughter thought handling money would be simple because she knew his phone password and even his bank PIN. But the moment the bank was informed about Robert's death, everything changed instantly. The account that looked perfectly normal just yesterday was now marked as restricted. The debit card stopped working. Online transfers failed. Even automatic payments began bouncing. The family was confused because the money was still clearly visible in the account. It hadn't disappeared. It had been locked. The daughter rushed to the bank thinking there must be a mistake. She showed ID. She explained she was his child. She even had access to his phone and personal details. But the bank staff told her something that sounded cold and final. We cannot release funds without legal authorization. In that moment, she realized something important. Emotional connection means nothing in banking law. Only legal ownership matters. This is where most families face their first shock. When a bank learns about a customer's death, it doesn't care who knows the password. It doesn't care who is closest emotionally. It only follows strict legal procedures. The reason is simple. If banks release money to the wrong person, they can be sued later by the real legal heir. So the safest option is to freeze everything first. This process is not random. It is tied to something called estate administration. When a person dies, their money becomes part of their estate. And the estate is not controlled by family feelings. It is controlled by legal systems like probate courts. This means the bank must wait until a court or legal documents confirm who is officially allowed to take the money. Now here comes a surprising twist. Robert's daughter believed that being the child automatically gave her access. But legally, that is not true in many cases. If there is no joint owner or beneficiary listed on the account, the money often goes into probate. That means it can be locked until legal processes are completed. And this process can take weeks or even months depending on the case. Probate sounds simple, but in real life it is slow and emotional. Courts need death certificates, identity proofs, asset details, and sometimes even hearings if disputes arise. Lawyers get involved. Paperwork increases. Time passes. And while all this happens, the family may still need money for daily survival, bills, and funeral expenses. That is where frustration begins to grow. Robert's daughter then discovered another shocking fact. Even if someone has a will, it does not always directly control the bank account. Why? Because bank accounts often follow contract rules, not just wills. If a beneficiary is listed on the account, that designation can override what is written in a will. This single detail has surprised many families worldwide. In Robert's case, there was no updated beneficiary form. There was no joint account holder. There was only a standard individual account. That meant everything now depended on legal approval. And until that approval came, the money was frozen. The family could see their savings sitting safely, but they could not touch it. Meanwhile, bills don't wait. Rent doesn't wait. Funeral costs don't wait. This creates an emotional contradiction that makes the situation even harder. A family that is already grieving suddenly has to deal with financial stress at the exact same time. This is one of the reasons why many experts say estate planning is not about money. It is about reducing suffering. But the biggest shock was still ahead, because Robert's case was not unusual. In fact, millions of families in the US alone face similar delays every year when accounts enter probate or get frozen due to missing beneficiary details. Some families recover funds quickly, others wait months, and some never fully understand why the system works this way. After Robert's death, his daughter starts noticing something strange. Not every family in the same situation is facing the same problem. Some people get access to money within days, while others are stuck for months. This is where she learns a disturbing truth. Bank accounts don't follow emotions. They follow ownership structures written quietly in paperwork most people never read. One of the biggest differences is something called a joint account. If two people own a bank account together with rights of survivorship, the surviving person can often continue using the money without going through long court processes. In many cases, the account simply updates ownership after the bank verifies the death. This makes it one of the fastest ways to transfer money legally. But Robert's account was not joint. It was a single owner account. That small detail changed everything. The moment moment the bank confirmed his death, the account shifted into a legal category called estate asset. That means the money no longer belongs to everyday banking access. It now belongs to a legal process that must decide who is entitled to it. Here is where most people get confused. They assume having a password or PIN is enough, but banks don't work like social media accounts. Even if someone knows every login detail, it doesn't give legal authority after death. In fact, using a deceased person's account without permission can create legal complications for the family. Robert's daughter then hears another term that changes everything: payable on death, also called POD. This is a simple bank form where the account holder names a person who automatically receives the money after death. No probate delay, no court battle in many cases, just direct transfer after verification. But Robert never filled this form. This is where the emotional impact becomes heavier, because something so simple, a one-page form, could have saved months of waiting, but most people never complete it. Studies and financial advisors often note that a large portion of adults do not have updated beneficiary details on their financial accounts, which creates delays for families later. Now the story takes a more shocking turn. Robert's daughter visits the bank again, hoping for a faster solution, but she is told something unexpected. The bank explains that even if the family urgently needs money for funeral expenses, they cannot simply release funds without legal approval. In rare cases, small withdrawals may be allowed, but only under strict conditions. This is when she realizes something important. The bank is not acting like a helper. It is acting like a gatekeeper. Its job is not to decide who deserves the money emotionally. Its job is to avoid legal risk. If it releases money to the wrong person, it could face lawsuits from other potential heirs or creditors later. Another hidden layer appears: debts. When a person dies, their financial obligations do not instantly disappear. Creditors may have the right to claim repayment from the estate before inheritance is distributed. This is another reason why banks and courts move carefully, because they need to ensure debts are handled properly before final distribution. At this point, Robert's case is no longer just about one family. It becomes a window into a global financial system where timing, paperwork, and small decisions decide everything. A missing form can create months of delay. A joint account can bypass the system. A beneficiary update can completely change the outcome. And this leads to one of the most shocking realities in modern banking. Billions of dollars remain unclaimed or delayed across systems because people forget to update account details, never name beneficiaries, or don't understand how ownership rules work. The money isn't gone, it is stuck in legal waiting rooms. Robert's daughter finally understands the truth. The system was never designed to punish families. It was designed to prevent fraud, disputes, and financial mistakes. But in doing so, it creates emotional stress for families who are already dealing with loss. And now she is left with one final question: why is something so simple in life so complicated in death? Robert's story is not unique. In fact, across the United States and many other countries, families regularly face delays when a bank account owner dies. The process is not about emotion or urgency, it is about legal validation. Banks wait for documents like death certificates, court orders, or beneficiary proof before releasing money, even if the family is struggling financially. In real-world situations, this creates a painful gap. While the legal system is verifying ownership, families still need to survive. Rent, electricity, groceries, and funeral expenses do not pause. Many people assume banks can help quickly, but financial institutions are bound by strict compliance rules to prevent fraud, identity misuse, and wrongful withdrawals after death. One of the most common real-life problems happens when accounts have no updated beneficiary. In such cases, money often goes into probate. Probate is a court-supervised process that decides how assets are distributed. Depending on the complexity of the case, it can take weeks or even months, and sometimes longer if disputes arise between family members or creditors. There have been many documented situations where families expected immediate access, but instead faced long delays. Even small mistakes, like outdated forms, missing signatures, or unclear ownership, can push accounts into legal review. What feels like a simple bank balance suddenly becomes a legal asset locked inside administrative procedures. A shocking reality is that this system affects billions globally in delayed or unclaimed financial assets. While exact numbers vary by country, financial authorities consistently report large amounts of unclaimed money sitting in banks, insurance systems, and government custody simply because heirs never completed the required steps or were unaware of the accounts. But here is the deeper truth. Banks are not trying to take money money away from families. They are trying to ensure the money goes to the correct legal owner. If banks release funds incorrectly, they risk lawsuits, fraud claims, and financial liability. So they choose the safer path: freeze first, verify later. This is the core principle behind most post-death account restrictions. Now consider how simple choices during a person's lifetime completely change the outcome. A joint account with survivorship rights can allow smooth transfer. A payable-on-death designation can bypass probate. Updated beneficiary forms can reduce delays significantly. The system is not random. It responds directly to how the account was structured before death. Robert's daughter finally understands something painful but important. The confusion is not caused by banks alone. It is caused by lack of preparation. Most people spend their life focusing on earning money, but very few think about how that money will legally move after they are gone. And that gap creates stress for families at the worst possible time. As she looks at the frozen account, she realizes something deeper. The money is not lost. It is not stolen. It is simply waiting inside a system built on rules, not emotions. And those rules do not change based on urgency, grief, or need. They only change based on documentation and legal authority. This is why financial experts often emphasize estate planning, not as a luxury, but as a necessity. Because without clear instructions, even simple bank accounts can become complex legal puzzles. And those puzzles are solved not in days, but in legal timelines that families cannot control. Robert's story slowly becomes a lesson for millions of viewers. A lesson that money in a bank is not just numbers on a screen. It is part of a legal structure that only works when everything is correctly documented. One missing detail can change everything for the people left behind. So the final question is not about banks, and not even about money. If something happened to you today, would your family be able to access what you worked your entire life to build? Or would they discover that your wealth is locked behind a system they never understood until it was too late?